Hey guys, this is Scott Horne. Just wanted to take a minute and talk about knowing your exit strategy before you go out and borrow money, whether it's hard money, a bank loan, private capital, whatever it might be on your real estate transaction. So many investors get so hyped up because they buy a property and they get a chance to buy it, go under a contract to get this property bought. They're looking for their financing in place. But have they really thought about their exit strategy yet? And what are they going to do? Is this going to be a traditional fix and flip? Are they going to hold it for rental? Or are they going to live in the property? Every deal that you look at is different out there. Now, it is so important to be thinking of exit strategy because anything and everything actually does happen in the real estate investment industry out there. For instance, you buy a house. It needs renovation. You're going to borrow hard money, meaning short-term capital. And by short-term, 6 months, 9 months, maybe a year, but usually a short time frame. And of course, if you've got to go through a renewal and an extension, that means more money, more fees. The whole thing is what is your back-end strategy? If it is a fix and flip where you're going to sell retail, what's your rehab time? 2 weeks, doubtfully. 30 days, 45, 60, 90, longer. Once you get to that point in time, the question then becomes, what are the average days on the market for that house in order to sell, in order to get cashed out? And those time frames today are extending. The days of 1 or 2 days to go to contract and close in 30 days, over. We're seeing here in the Dallas-Fort Worth area, at least, and part of the Texas marketplace, that time frames are exacerbating up to 90, 120 days or more. And so you've got to be anticipating that and build it in, because now you got to make certain you have reserves for your interest carry, your time frame, and maybe pricing adjustments along the way to get your house moved. Remember, time is money in our business. One thing I see so many investors not think about is the what if factor. What if the house doesn't sell? It can happen. It does happen. Did you misinterpret the value of the home when you bought it? Very possible. Did you have cost overruns on your repairs? Very probable. Your net profit shrinks. And so now you want to keep your price high in order to get your price, but the house won't sell and you got to bring it down. And all of a sudden, maybe you're at break even or possibly even losing money on the deal. Now, I call that the investor paradox, by the way, because investors, they wind up with so much money in the deal, they can't adjust the price low enough in order to get out of it, and they wind up getting foreclosed on instead. Remember, be smart, be wise. In those situations, if you run into it, price the house right, sell it, cash out. I get it, you might lose a little bit of money. No one wants to do that, but it allows you to live and invest another day. That's the important part along the way. But another angle of this you've got to think about is what if the house doesn't sell and you got to cash out of that hard money loan versus getting foreclosed on? Have you actually thought about how you're going to do that? Can you do that? Do you have another investor you can sell the house to? Can you go through a DSCR loan, a bank loan, a private loan? Do you have people you can call or not call? You've got to have your ducks in a row so you don't stub your toe, because all of these things will happen. And I usually like to tell investors you need multiple exit strategies on any transaction that you're doing. If your goal is to go into this transaction as fix and flip, and you wind up maybe being too deep in the deal because of cost overruns that you didn't expect or anticipate, I got it. By the way, we will have all been in those scenarios before. So what's your option? Do you want to hold that house for a while, maybe pay the loans down in some format in order to build up more equity? It's a solution. But to do that, you've got to put in place longer-term financing. Your hard money lenders will rarely do long-term financing. If it is, it's going to be at very high interest rates that make it untenable to work within the scope of their loan. So you got to make sure you have either institutional capital, that means banking capital, the ability to go through a mortgage company or a DSCR loan, whatever it might be, to cash out of that deal that allows you to hang on to it in another fashion. And then can you rent that house and get it to cash flow? Hopefully the answer to that question is yes. So all of these things are problematic in the investment world. And so before you just dive into your transaction, know what your exit strategies are. Know what you can do with it. If I can't do a fix and flip, can I do a long or short-term rental? Do I really want to do maybe an Airbnb short-term rental or just do a mid-term, long-term type rental? Do I have an option of maybe doing a seller finance if I can get my long-term financing in place? All possible. But then you go one step further. What's my next exit strategy? Can I sell that rental property to a rental investor? Maybe. Can I wrap this mortgage and maybe sell the mortgage into the secondary marketplace that allows me not only to pay off my hard money loan, but maybe put some capital in my pocket? And so you want to be able to think through your transaction and expect and anticipate these things to happen and have a contingency plan. That's what will, at the end of the day, make you a solid investor where you're out anticipating things to happen. Hopefully they don't happen, but in the event they do, you're prepared for it and you don't squander away your profit or your deal, or worse, risk of foreclosure on the property. So guys, I hope this helps you out a little bit in considering your exit strategies on transactions as you're deciding what type of a loan to get, especially that's a hard money loan out there. And we'll see you guys next time.